Hello everyone. I will continue with rest of chapter 4 in this lecture. So we start with the concept of risk. In the previous lecture, we looked at the concept of return and the different measures of return. Now we look into the details of the concept of risk. Risk means the uncertainty with respect to the actual return from an investment. So that leads us to the risk-return trade-off. The investor will always try to achieve the maximum possible return for a given level of risk, because most investors are risk averse and they are looking for compensation for whatever risk they are assuming. So we look into different aspects of risk in this. So what are the sources of risk? Business risk, that is the uh, risk associated with the business of the company which has issued the asset. So it could be due to the quality of management, it could be due to the business model, and so on. Then we have financial risk. This is the uncertainty with respect to the debt assumed by the company. The company has to pay interest, the company also has to repay the principal. So that has an impact on its profit as well as on its cash flow. So it may have an impact on the returns. It may negatively impact the returns. So this is also a source of risk. Purchasing power risk is due to changing price levels. So due to inflation, price levels may rise, because of which the company's business may get affected, and the investors may want higher returns, which the company may not be able to provide. So that is a source of risk, uncertainty in the returns investment. Interest rate risk is more relevant for debt instruments. It also impacts equity instruments, but more in the case of debt instruments. So let's say interest rates rise. So in this case, what happens is existing debt instruments will decline in value. So that is a loss of return. But on the other hand, the reinvestment opportunity increases. Any amount that has matured and is available for investment, it can be reinvested at higher returns or at higher interest rate. So existing investments may suffer, but there is scope for better investments in future. Liquidity risk, lack of buying and selling opportunity of a security. So if the investment is not liquid, then an investor has to hold on to that asset for a longer time. They may not be able to sell it off or buy it whenever they want. Tax risk is related to the business environment or the political environment. So if the government comes up with unfavorable tax laws, it will have an impact on the profit, and hence it will drive down returns. So if there is change in returns, or if there are factors which negatively affect returns, then it is a source of risk. Other sources of risk, event risk, maybe a single event which has an impact on the value of the investment. Take the example of pandemic. So it affected the equity investments, debt investment in a significant way. Market risk means any factor that affects the broader market. Again, it can be the pandemic. It can also be financial crisis, which impacted the market across the board. So all instruments were negatively impacted, and it was a source of risk to the returns generated by different investments. So how do we measure risk? The most commonly used measure is standard deviation. So this is the variation or fluctuation of returns above the average return. So we look at the historical annual returns over couple of financial years. We have considered two stocks, Target and American Eagle Outfitters. Now we have found the average return for the period in question. And then we have found the difference between a particular annual return and the average return over the whole period. And that helps us to find the standard deviation as well as the variance of return. So we have done it for both companies. And we have found the standard deviation for target stock as well as standard deviation for American Eagle Outfitters. So if it is a single asset, we use the standard deviation of returns as a measure of risk. We generally see that investments which have higher standard deviation, they reflect higher risk, and hence they are expected to generate higher average returns. So we look at different asset classes in different countries. So if you notice, stocks on average generate higher returns, but at the same time, they also have higher risk because the standard deviation of returns is higher. This is in comparison to debt instruments like short-term government securities as well as long-term government bonds. This is a graphical depiction of the previous slide. So what we notice is the risk-return trade-off. The higher is the risk, the higher is the expected return. So in each country, if you notice, the asset class with the highest risk-return trade-off is always the stock. So how do we assess risk? We assess risk in order to understand the risk-return characteristics of an investment and whether it provides suitable returns compared to the risk involved. So what we notice is that government securities generally have a low risk return trade-off. So low risk and also low return. Whereas equity, real estate, derivatives, they have higher returns and as well as higher risk involved. So this is a graphical depiction of the discussion in the previous slide. So why is risk assessment necessary? Because different individuals have different levels of risk tolerance. Some individuals are risk neutral, so they do not expect higher returns in compensation for assuming higher risk. Then we have risk averse investors. These are the majority. So they expect higher returns to compensate for assuming higher risk. And finally, we have risk seeking. So these are investors who will accept lower returns if they have to assume higher risk. So based on the risk tolerance of the investors, we need to find what is their expected return and whether the risk return trade-off in any investment matches with their expectations. So hence, assessment of risk helps to understand the suitability of investment. So in this case is the example. As risk increases, risk averse investors demand more returns from their investment. So what are the steps in a nutshell? So first of all, we have to consider different investments and find their return using different methods like internal rate of return, net present value. And then we find out the risk associated with that investment. So now we have the risk return characteristics of each investment. Then we try to map it with the risk return trade-off for different individuals. This will depend on the risk tolerance of each individual. And the investments which provide attractive risk return trade-off for any individual, that will be more suitable. So that's all for chapter 4. I'll stop here. Thank you.